Our next guest saying 2023 will present opportunities for investors despite those rates that are rising. Anthony Landahl joining us from Equilibria Finance. Anthony, great to see you. So, yeah, I mean, obviously the concern is those rates are continuing to rise, but perhaps at a reduced pace. At what point does an investor, I guess, look at this and think, well, here are some opportunities? Because, of course, as a result, we have seen property prices fall.
Yeah, nice to be here, Andrew. And that's a good question. A lot of focus on at the moment is on home buyers and the impact of interest rates. But I think for the investors, there's a number of factors that the smart investor or the savvy investor who's not fearful of buying in a downward market would be looking at. As you say, we've probably seen the worst of the rate rises over, albeit we're looking at more rate rises in the months ahead, anywhere between 2 and 4, depending on which commentator you listen to. But there's a number of factors that investors will be attracted back into the market, I think. We've got declining house prices coming off, the worst of the rate rises are over, and we've also got very strong rent. So from an investor perspective, cash flow is going to be pretty strong. Vacancy rates in some areas are as low as 1.4%. I think Sydney and Melbourne was around about 1.4%. And we got migration coming back in, overseas students. So investors last 12 months have been down about 23% in terms of finance. Their activity has really slowed while those rate rises come in. But I think there's a number of factors that the savvy investor is going to start looking at entering the market with such tight vacancy rates, cooling prices, and those increasing rental yields.
Yeah, so yields, so they are looking attractive then, particularly, where specifically, when you say some of those rental markets are so tight, is that in the major cities?
Well, Sydney and Melbourne, for example, their vacancy rates are around 1.4%. And their gross rental yields are up anywhere between 15 and 20%. So the major cities, for example, Sydney and Melbourne, have very, very tight vacancy rates. It varies. Some of the other majors, Perth, Adelaide, might be more around gross rental yields of 5 to 10% growth, and vacancy rates not quite as tight. But nationally, we've got very, very tight vacancy rates and growing rental yields.
What about first-time buyers, not necessarily as owner-occupier, but investors? If you haven't waited in there before, I mean, it can be quite daunting, particularly if you are seeing house prices fall. You think, do I really want to try and catch a falling knife? But you're saying, well, look, it's going to come back up. I guess it's a question of when, but by the same token, those yields are looking attractive. So
that's
how do you time it?
I think for a first-time investor, it's about understanding the fundamentals of an investment as distinct as from buying a home that you're going to live in. And the fundamentals of looking at an investment are going to be looking at your cash flow, looking at your return on your investment. You're going to be looking at what you're investing in, factors such as the infrastructure, the growth in the region, the vacancy rate. Some regions might have different vacancy rates and rental yields. So it's really about understanding the fundamentals of the economic environment you're in, and then the fundamentals of the market you're looking at buying in. The other thing for a first-time investor is to approach it as an investment, as distinct from a place you're living in, and what the objectives are of that investment. Is it capital growth? Is it rental return? Is it cash flow? And then start understanding those markets that might deliver that on your strategy.
More broadly, beyond the investor market, how are mortgage holders travelling at the moment? Because obviously rates are still rising. Anecdotally, at least, we are hearing of some significant pain there, some trying to scale back their spending. Is there any forced selling that's of note?
Look, I think anecdotally what we're seeing is that the impact of the rate rises is actually starting to hit the hip pocket. We're having more conversations. We're doing a hell of a lot of repricing with existing providers and existing mortgage holders. Somebody who bought 2 or 3 years ago, they might be paying 40 to 50% more than what they were. So it was $1,000 a week, might be $1,500 a week. That is starting to impact home buyers. We're not really seeing a lot of people saying, hey, we've got to sell or throwing the keys in. I think partly because of the large buffers that people had. They had a lot in redraw. They were coming off the low rates. The next 6 or 12 months, I think, are going to be interesting. The serviceability buffer is going to be surpassed by the interest rate increases. What I mean by that is loans are serviced at 3% above the rate. Interest rate, the next interest rate rise is going to see that surpass that serviceability buffer. We could start seeing some portion of the population starting to struggle a little bit more than they have been.
Yeah, how precipitous is that likely to be though, where if you are starting to get forced selling, then of course that's going to push prices down even lower, isn't it?
That pushes prices down even lower, and it tightens the rental market more as well potentially. So there could be a confluence of factors affecting that. I was reading some data recently where Westpac suggested maybe there's about 14 or 15% of their mortgage holders who might start falling into negative cash flow positions out of their pool of total mortgage holders. So that gives a bit of an indication of the sort of proportion of people that might fall into that category.
There's a lot of speculation about the so-called mortgage cliff that's coming in those mortgage holders who are rolling off from fixed to variable. What do you foresee as the impact of that? How significant is likely to be?
Yeah, a lot of this is going to happen probably in April, May, June, and through the rest of the year. It's possibly going to impact up to about 800,000 mortgage holders. Anecdotally, the data's sort of telling us when you look at all of the banks who are coming off fixed rates they put in place 2 or 3 years ago over the next 12 months. People who might have fixed at 2%, depending on what happens with the RBA, their rate might be up to 5.5% or 6%, which is a massive jump. That's an increase in repayments of say 50 or so percent, 40 to 60%. So it's going to have a big impact. Look, I think most mortgage holders are reasonably responsible. I think most mortgage holders are making adjustments. I think a lot of mortgage holders are already starting to look at their budgets and the repayments that are going to be associated with that. I think the areas of concern are some of those areas where if rates go up, say 4 more times, another percentage, then we are starting to get people coming off a 2% rate going to say 6%, which is a massive leap. And some of those larger mortgages are really going to feel that. Do I see a mortgage cliff? Look, it's going to impact people, no doubt about it. But I think a lot of people are in the background preparing for it. They've got funds in redraw from being on the low rates, or they're starting to make repayments as though they're already on those higher rates.
Looking ahead to the RBA pausing and perhaps beyond that to cutting, which is a likelihood, it's a question of when. Do you feel as though perhaps the market will be exhausted and it will sit there, or there'll be a significant snapback?
Yeah, look, I think in general in the market there's a lot of home buyers who are waiting to see if the market drops a little bit more. Not only investors but home buyers. I think if we see another 4 interest rates rises, I think we're going to see a real slowing in the market. And I do think that'll take a little bit of time to recover if the Reserve Bank then starts cutting the rates, just because of what everyone's been through with rate hike after rate hike in conjunction with cost of living pressures. People are not able to save as much as they were through the COVID time when we had the low rates. There were a lot of savings buffers created. So I think it will take a little bit of time for the market to, I guess, recover or grow again. But in saying that, we're coming off one of the fastest periods of growth we've had for a lot of time. So a lot of the behaviour in the market is a correction. We're still above pre-COVID levels. We're down about 8.9 or 9% over the last 12 months in a market that grew over 20%. So it's pretty resilient, the housing market. I think it'll take a little bit of time once rates drop to find its feet a little bit again, but I think that's partly on the back of other influences just outside of interest rates, with cost of living pressures, savings buffers, and just the general supply coming back in on the market.
You're following, we're involved not just in home lending, but also small business lending as well. What are you seeing there at the moment?
Yeah, we're seeing a slowdown in a lot of areas of small business lending, mainly around investment in business, and that's beyond just what's happening in interest rates. We've obviously seen the cost of money go up a lot. There's a lot of other factors that are influencing that. There's a lot of uncertainty with small business about what might happen in the Australian economy. Potentially we're looking at a budget surplus, funnily enough, on the back of our resources sector, but that's more on the back of increased prices and revenue coming in. I think there's a little bit of uncertainty in small business around some of the legislation in the employment market and what might happen with some of the changes in the economy. Small business lending has slowed, particularly investment in your business. There's still a demand for cash flow lending and looking at managing your working capital, but actually investing in your business, that has slowed. We've definitely seen a slowdown in that over the last 6 or 12 months.
Are you hearing perhaps from clients, are they cutting costs now? Are they letting staff go?
We're not seeing that so much. We're still seeing a pretty tight employment market. It's a very competitive employment market. We're more seeing small businesses are generally trying to hold on to their team. They're fairly buoyant in a lot of senses. They're just a little bit sheepish around putting their hand in their pocket to invest in the next phase of growth, just while the new government policy and legislation starts, I suppose, directing and stabilising.